Economist. We're joined by Gary Ng. He is senior economist at Natixis for more on the tariff fallout. Gary, good to have you on the show as always. The market sell-off was a surprise to many. Did you expect it to be so severe? Do you see the market stabilizing anytime soon?
Well, it is really not only an overreaction that we see right now because we are talking about structural changes in the global trade and investment order. And of course, in the short run, the market is actually repricing the risk of a recession that we see from all these U.S. policies. It's possible to see some stabilization if the U.S. is able to show a softened stance and negotiate with some countries such as Korea, Japan, and the U.S. allies. But I think we need to be mindful that in the long run, there are a few factors that has changed that may actually continue to bring volatility to the market. Well, first, the phantom of tariff may actually come back again and again if the U.S. is willing or wants to negotiate on multiple issues. And second, we may have already passed the point of no return between the U.S. and China competition, that there are many unsolved issues that may continue to bring turbulence to the market. And lastly, we are also facing a U.S. president that is willing to risk growth and the market movement for their own policy agenda. So all of these factors may not really be, a risk that can fade that easily, and it can probably stay in the next couple of years.
Gary, it's Jill here. Now, the Chinese reaction you talked about briefly to the first two tariff hikes was moderate, but what do you make of the response this time round?
Well, I would say what we see so far has been tougher because in the past, it pretty much followed the same playbook of, you have some tariff retaliation. There's also increasing export control and also the restriction of the market access of some American firms. But this time around, in terms of the first part, it is really a full-blown tariff matching in terms of the rates and also on all the products. So definitely the response has been tougher. But having said that, even though the chance of China and the U.S. Of reaching a deal may be reducing, and China definitely also think it that way in terms of it's quite hard to really fulfill what the U.S. wants, but there's still some room for negotiation because if you look at all this export control and market access restriction, there's a lot of gray area that are still open to interpretation. There's not a full ban on a lot of this export right now. So yes, the situation is getting worse. It's getting tougher from China's side. But, maybe there can eventually still be a deal if there is a softer stance between the two countries.
So the situation you're painting already seems to be quite bad, but can it actually get any worse? I mean, does China have space to continue ratcheting up its retaliation?
Well, I would say it is not only an economic question because it is really a politically correct move for China to retaliate against all the measures that the U.S. is taking place. And going back to the point that we covered in the last question is that there's increasingly smaller hope for China to reach a deal with the U.S. because it doesn't really think that they can offer what the U.S. wants. And there's also a limit on how much it wants to make in terms of the concession. So if we have that in mind, then definitely we are expecting a full-blown retaliation if there is any step up of the U.S. policies. So therefore, I think it's likely that China will use its domestic policy tools, basically stepping up fiscal policy, cutting interest rates to provide monetary support to basically bring the domestic economy on track. Even though it may not fully offset what is going on around the world, this is at least a gesture or some policies that can help stabilizing the local job market and also the growth prospect.
So, Gary, how's this for a potential retaliatory step from Beijing? There are reports that Beijing is barring Chinese companies from investing in the U.S., and that prevents them from participating in Trump's efforts to revive America's manufacturing industry. Is that significant at all?
Well, I would say that if you look at the FDI into the U.S. over the past few years, we have already seen a sign of decoupling between the two countries. So I would say that if Trump's tariff actually make it much harder for other big manufacturing powerhouse like Japan, Korea, or even Germany investing in the U.S., then the impact may be actually quite large if the mistrust continue to grow between all these countries. But for the case of China, well, there there may be specific impact of some sectors like the green energy, electric vehicle, etc. But on a broad micro or macro level, then the impact of the further restriction may not be that big for the case of the US, given the already very, very small exposure.
Gary, one final question before we let you go. The state-run People's Daily suggesting that China's mega-sized economy can withstand the pressure. Beijing obviously putting on a very brave face, but has Natixis actually projected how much of a drag this tit-for-tat tariff hikes could actually impact China's GDP growth?
Well, if we look at the full-blown tariff increase of the US on China, it's possible to see a 3 percentage point reduction in China's economic growth if we consider not only the direct export number, but also the linkages towards investment, consumption, and also other job creation. But having said that, this is only a number of the direct hit by the US. It doesn't mean that the Chinese government will not do any other things to help mitigate the impact. So for the full year, we still expect 4.7% growth rate in 2025, but it is on the assumption that fiscal and monetary policy will really become more accommodative in the future.